Hi everyone, welcome back to Corporate Decoder. Today we're diving into Femto Technologies Inc.'s latest SEC filing, which is basically like reading a company's diary, but with dollar signs and legal jargon. I've seen filings boring enough to put a caffeinated sloth to sleep, but let's see what we can uncover about Femto. This filing is their attempt to register shares for resale by some big shareholders. This could mean big changes for the stock and our wallet, so stay tuned. What's happening is that Femto Technologies isn't actually selling any new shares themselves. Instead, some of their current shareholders are planning to sell their existing shares to the public. These shares come from a previous private placement and from warrants, which are basically options to buy shares at a set price. Now here's the kicker. The number of shares these shareholders might sell is huge, over 23 million. That's almost 80 times the number of shares already out there. Imagine a small town suddenly expecting 80 times its population to move in. Things are going to get crowded, which in stock market terms means the price could drop. The big risk? This massive potential sale could flood the market with shares. When there are way more sellers than buyers, the price goes down. Also, even if the sales don't happen, just the fear that they might could scare investors and drive the price down anyway. Currently, Femto shares trade on the Nasdaq Capital Market under the symbol FMTO, which last sold for just over $3. We need to keep this in mind. Now, let's get to the issues that could make your investment feel like a roller coaster ride. First, Femto is very clear that their main offices and research are located in Israel, and the ongoing war with Hamas poses a direct threat. This isn't just background noise, it's a factor that could seriously disrupt Femto's ability to operate. What the company is saying is that all their plans are behind schedule due to employees being called up for reserve duty, the economy slowing down, and shipments being delayed. They also decided to stop working on the cannabis farm because it was too close to the Gaza border. They are hoping things will get back to normal and the product could launch in the second quarter of 2025, but they're not really sure if or when that will happen. This means they could see less money coming in this year. Next, we have some interesting governance issues. The CEO was issued enhanced voting preference shares, which allows him to exercise a crazy amount of control. The preference shares carry 50 votes per share, giving him substantial influence over all shareholder decisions, regardless of what other shareholders want. Also, during a recent private placement, the company issued a ton of units with warrants, which could mean major dilution for existing shareholders. These warrants include anti-dilution provisions, which will reduce the warrant exercise price when the market price of the common shares falls. So the potential for future dilution is very high. Moving on to the business itself, a big area of focus for Femto is their sensor device for women's health and pleasure. However, they admit they've never made a single dollar from it, and they don't expect to make money from it for at least another 3 months, so they may never be profitable. On the other side of the business, Femto has a customer relationship management, or CRM, software. Currently, a large amount of revenue was derived from just one major customer, so if they lost that client, it would have a major impact on current revenues. A gamble that didn't pan out. They have the contactless business license to operate cannabis farm, but its extension is contingent on the Ministry of Agriculture, which hasn't yet been obtained. If they can't get it, they won't be able to carry on with the proposed cannabis farm and indoor facility. Finally, the report presents some summarized financial data. Let's break down the most crucial numbers. First of all, the total revenues. For the year ended December 31, 2023, they made $123,866,866,864 and $664,684 and then $23,123,072 and $20,95,000 $1,021 compared to a net loss of just $1,664,664 $684,640.95. Total assets have decreased from 49,903,208 CAD in 2022 to 36,801,368 CAD in 2023. T3 and 2023. That looking at the 9 months ended September 30, 2024. The company recorded a net loss of 35,958,412 Sayedi. We can notice that they managed to hold the total revenues at roughly the same level, but the net loss increased tenfold. So what's the big picture here? Femto Technologies is a company trying to pivot and grow, but facing a lot of significant risks that could send that strategy off course. The heavy reliance on a single CRM client, the war in Israel, the unproven sensor device, and the potential market flooding from those shareholder sales all paint a concerning picture. The large number of warrants and shares being registered for potential resale add another layer of uncertainty, which, as we mentioned earlier, could depress the stock price significantly. This isn't just about Femto's performance, but also market psychology. Remember, fear can be a self-fulfilling prophecy on Wall Street. That being said, if Femto can overcome the security situation in Israel, diversify its revenue streams, and successfully launch the sensor device, there may be a chance for a profitable upside, but it's a high-risk, high-reward scenario, and certainly not for the faint of heart. Ultimately, the health and pleasure for women is a growing market, and the new technology that company is working on is an interesting development if it's successful. Ox, thanks for watching. If you enjoyed, please subscribe, like, and comment.